Hello, everyone. Welcome to the BTC sessions. I have an awesome guest today. His name is Stephan Livera. Stephan, welcome to the show.
Thanks for inviting me, Ben. I'm a fan of your work as well.
Awesome. Yeah, I'm really glad to have you here. We got to meet a couple times. I met you at Bitcoin 2019 in San Fran, and we recently saw each other in Riga for Baltic Honey Badger. So really happy to catch up with you on the show, and I think we're going to be able to dive into some fun topics today.
Yeah, it was great to meet you as well. I think, unfortunately, Bitcoin 2019 was just so hectic. We sort of just passed each other, and there was just so many things happening. But with Riga, we actually had a chance to actually have a chat, so that was good.
Yeah, absolutely. So I'm just going to dive right into it. So a lot of people come to my channel for a lot of basic tutorials or daily news, stuff like that. But I don't dive too deep into the economics of Bitcoin and get super specific about stuff. And you kind of come from an area where that's kind of your forte. And so that's why I wanted to have you on and why I wanted to dive into things. So I wanted to start pretty basic, and I was wondering if you could touch on what we are currently taught, assuming any education around monetary policy and finances that we get in school. What are we currently taught with what's known as Keynesian economics, and what are kind of the lessons that we learned growing up about money?
Yeah, great question. So first of all, many of us are not taught economics, right? So often it's the people who elect to study economics in high school or study economics at university level who even get a basic understanding. Most other people are just hearing about things on just standard financial news and so on, right? And in terms of what people are taught, they're not really taught in terms of how money can be emergent, right? So sometimes you might get some vague ideas around a free market and some vague ideas around what socialism is. And they might sort of give you a very sort of watered down conception, if you will, a very watered down view. And so typically when you're taught a lot of Keynesian economics, there is this focus on things like aggregate demand, right? So it's about, and there's a focus on things like, consumption first. And they'll say things like, for example, there's this thing called the paradox of thrift, right? And there'll be certain ideas saying, oh, look, saving might help you as an individual, but it hurts society and you shouldn't save, right? And so some of these different concepts, and I think they come off a little bit confused. And the reason for that is some of them are not logically precise enough, right? And that's where we contrast with Austrian economics. And Austrian economics comes from what we might call, so it's known as the causal realist tradition. And think of it like we're using deductive logic to figure things out. So we start from a certain premise. So for example, man acts purposefully. And then from those premises, we sort of reason out and deductively kind of use logic to understand and reason about certain principles that can apply in our world today, right? Now, this is a little bit theoretical and a little bit kind of technical, but let me sort of bring that back into a more basic level of what typically gets taught. So, for example, if you go to school and you learn economics in high school or basic level economics at university, they will teach you things like the government needs to manage the money supply. And that they will think of it like, there is this business cycle, and they think of it like, okay, the Keynesians and the monetarists believe, that there are things that the government can do to intervene into that cycle to try and smooth it out from their point of view, right? Mm-hmm. So if you look at the different central banks around the world, Bank of Canada, Reserve Bank of Australia, Federal Reserve, etc., they typically have different mandates, but they will typically be things like, economic stability, promotion of, not having too much unemployment. And, they might think of it like even sometimes falling prices is bad, right? Mm-hmm. And so it takes a little bit more work to sort of dig deeper and understand a little bit more around what's the real truth around some of those things. Because again, it's not, I don't think of it like it's a malicious thing. It's more like people are to some extent misguided or taught the wrong way, and then the incentive sort of drives them that way. So for example, if most of the jobs in the economics profession are in a central bank, who do you think is likely to get that job at the central bank? It's going to be people who believe in the existence of a central bank. And
Yes.
if you're an Austrian economist who is skeptical of government control of money, you're skeptical of central banks, how likely are you to get that kind of job? And, it's sort of like the incentives of the system kind of push it that way. And then people, we're human. Sometimes people, they want power. They want the ego. They want to feel important. And guess what? If you go down that pathway, you're more inclined to get into a position of power. You might be acting as an economic advisor for some big politician or some big president or prime minister, etc. You might have a nice fancy job in the central bank, right? So these are some of the things why it might seem like, Austrian economics is this crank monetary school, etc. But actually, it was more like there was no real difference between Austrian economics and just economics, right? If you went back years and years and years ago, here we're talking more like early 1900s and so on, right? So, and there were different schools then as well, right? There was the classical school of economics and so on. So there were differing schools, but essentially a lot of what we call nowadays as Austrian economics was just economics then. Yeah. And so what happened was a sort of influence in the direction of intervention. And so because it's sort of like the cards or it was stacked, the deck was stacked in that favor towards intervention because it's sort of just like that's where the money is going. That's where the money is coming from. And so it just became beneficial for politicians and other people in the government, like bureaucrats, who wanted a more interventionist flavor of economics, where they believe that the government has to help manage the consumption, manage the demand levels, or manage something or other, rather than Austrians who tend to be more from a free market approach, bottom up, this idea of appreciation of spontaneous order. And okay, in fairness, like there will be some Keynesian interest type people who pay some level of lip to the idea of the free market, right? So they're not like total socialists, right?
Yeah.
But they just believe that on this certain thing that the government needs to step in, right? They believe that were it not for the government, we would be in more, we might sort of spend more time in depressions, and that's sort of their view, right? I'm trying to be fair to that characterization, even though I disagree with that view, obviously. So I think it's another important concept is this idea of chartalism, which is state-created money, right? So think of that like, the kings of the land is saying, I say this is the money of the land. Whereas in the Austrian conception of money, it's more about what is the bottom up, how does it emerge spontaneously? And so we talk about it in terms of salableness. And that means how easy is it to store your value through time and space? And how easy is it to sell these different goods? Because these goods have differing levels of salableness. And so then the idea is it's easier, for example, let's say you're living in a town 1,000 years ago, gold was probably one of the more, the most saleable things in that town, because a lot of people wanted gold, not because they wanted it directly, but because they knew as an indirect medium of exchange, this made the most sense to hold. And so, I mean, there's a lot we can bring into it. What did you want me to expand on anything there?
So let's take a look when it comes to Keynesian economics and the rise of it, and some of those things like government intervention and government decreed creation of money. What have been some of the implications of a system like that? What have we seen happen in society due to that line of thought?
Great question. So we ultimately see, as a result of that intervention, we see things like these big bubbles happen. So we see resources get thrown into certain industries and into certain pathways that were actually not sustainable for society in the longer term. Now, that can be that's a very high level statement. To sort of dig into the actual detail of that, Austrians have this thing which we call capital theory, right? So the idea is when you are producing things, you have consumer goods, which are goods for consumption now, and then there is capital goods, right? Now, most economists understand that idea as well, but Austrians quintessentially appreciate there are differences in that capital, right? It's not, capital is not just one blob. Capital is, that you might have a tractor and I might have, some other kind of, equipment, and it matters where that equipment is structured in the economy, which we refer to as a capital structure of the economy. And so the Austrian conception then is more that as some of these interventions create money into certain places and they create certain availability of money in certain industries, what that drives is entrepreneurs into those areas when those areas aren't necessarily profitable for society considered, like on the whole. And part of that is, so we believe that prices and people's decisions to buy and sell these capital goods, right? These goods that we use to create consumer goods or even other capital goods, because there's a structure and there's an order to this production. So the Austrians would say that basically throws that structure out of whack when you inflate the money supply, and it matters where that money is inflated. So that's kind of the point around what we call Cantillon effects. So the point that an Austrian would make is that these Cantillon effects benefit those people who receive the new money first. Because think about it from this point of view. If, let's say, we're living in a small two-person economy, maybe I've got $100, you've got $100, and then the new money comes to you first. It's kind of like you get to spend that new money at today's purchasing power. And then by the time you've spent it and it's kind of circulated out into the rest of the economy, everybody else is only like it takes time for those other people to get some of that money. So then now they're paying the higher price without having the higher kind of income to make up for it. And that's where we see some injustice in the system. And also it drives other kinds of behaviors. So it can drive, in our view, sort of behaviors that are very sort of high time preference, degenerate views, right? It makes people do things that not consider their future, because it makes things like debt much more cheap, and it makes that can drive different decisions in the way we act. And so we can think of it like there are cultural consequences of fiat money, if that makes sense. So again,
absolutely. So, I mean, to your point of who gets the money first and how it gets inflated and where it gets allocated upon that inflation, a perfect example would be quantitative easing. A decade ago when it started, and how it went to now, correct me if I'm wrong, but the QE, we had money going directly into the banking system, which they were hoping would then be lent out to small business owners to build the economy. But a lot of it didn't go that way, right? It went into other investments and inflated the stock market further. Is that correct?
Right. So there's a few things with that though. So I would be careful, because in some sense, if they gave money just to lend it out to small businesses, even that might drive this tendency we're talking about. So actually at a more underlying level, what I'm referring to is the existence of the central bank, the existence of what we call fractional reserve banking. And so our view is that when the government creates these different legal tender laws, these capital gains tax laws, the existence of the central bank, what that does is it creates this artificial environment in which banks create money into existence when they loan it. And what that does is it drives that what we call malinvestment. And what that does is it drives these kind of bubbles, in speculative bubbles in different areas, whether that's real estate or .com bubble or etc. And so the point it would be about, in general, like loans, right? And so the way to understand that is when, if I'm a bank, and I guess using gold is probably a very easy example. So let's say I've got 100 pieces of gold in my vault, right? 100 ounces of gold. But if I now go out and I lend out, and let's say I gave everyone a ticket, and that ticket became treated like it was the same as a gold in the vault, like from my vault, from Stephan's vault.
Represented the gold.
And in the community, everyone's out there trading these little tickets of gold, right? Now, if I've got 100 pieces of gold in my vault and there's only 100 tickets out there, we're all good. There's no problem. But imagine what would happen if there's actually more paper tickets out there than pieces of gold in my vault. That's where we say there's actually going to become a bit of a problem there. And because of the way it works with those paper tickets, right? What I can do is maybe I could take some guy's deposit in, and then I can lend out a loan. If I lend out a loan and I'm creating, another 100 tickets, so now there's 200 tickets out there, but only 100 tickets in my vault. That's where you'll see that 200 tickets being out there and being treated all as the same as a piece of gold in my vault. That is what creates that sort of discoordination or malinvestment, if you will. Yeah. And then, so we would say in a full reserve system where you can't do that fractional reserve part, then that is what would sort of keep the production aligned more closely with what the consumers actually want. But you make a good point with the quantitative easing, because what that does is fundamentally, we should think of it like normally in a real free market, people would scrutinize their bank, right? They would look at their bank and they'd be like, I'm not sure if Stephan is legit. Is he really like full reserve? Does he really have 100 pieces of, does he really have 200 pieces of gold in that vault? Or does he actually only have 100 in there and there's 200 tickets floating around there, right? And so people would scrutinize their bank more. And so banks would live in fear of that. And they would be very careful to not, and maybe I might temporarily fluctuate like a little bit around the 200, let's say, in a full reserve system, but I wouldn't just kind of willy-nilly expand it out. And what we would say is that some of these central banks, the existence of them and the existence of government bailouts, which again is another thing that Bitcoin was created to basically stop, is government bailouts can give this problem of moral hazard, and they can also make banks go just expand out the credit without care for that problem we were talking about before, because then people can do a bank run. So essentially what happens is government sets up this institutional environment, right? The rules, the laws, the rules of the game, sets them up such that banks can just expand the credit and not feel the consequences from the market check that would normally happen if all the depositors at that bank said, hey, Stephan's doing fractional reserve, let me go out and withdraw I want to take my gold out of the bank because I don't trust him. He doesn't have enough gold for all the amount of tickets that are out there. And then what that would do is it would drive me out of business. And then only the good bankers would stay in business. But right now, it's almost like the government sets up this environment where we are forced to live with and interact with, quote unquote, bad banks, right? Yeah. And so what it does is essentially it becomes this kind of backer, the lender of last resort. It becomes a thing that to try and say, oh, you're in trouble? Let me just print up some money to keep you safe. And what it does is it drives this overarching, instability in the overall system. So one way to think of it is like, instead of maybe a good analogy might be like backburning, right? So, you got a forest and periodically there might need to be a backburning to sort of clear out the trash, right? Mm-hmm. But what if you tried to make it say, no, just don't do backburning and just like have one massive fire every 10 or 15 years, right? Instead of like periodic little fires. So it's sort of like a systemic risk point. It's saying we should let banks who have done bad business fail so that the overall system is more stable. And what we're living in today is a world of more instability thanks to central banks, legal tender laws, bailouts, etc.
And it seems to stem directly from the fact that growing up, we're taught that this intervention, it's entirely possible to actually get a handle on this and smooth it out to the point where there is no pain, there is no consequence of a poorly thought out business, like if a bank does something that's completely irrational or very, very risky, there's really, at this point we've been showing, not any risk to them, because they know in the end they'll get bailed out, too big to fail, right? And so in trying to defer these small problems, they don't go away, they just build and build and build until there's really no recourse to prevent them. And we're kind of seeing the fruition of that now, right? Like where interest rates are at record lows and we're starting to go up and then just reversed. We've seen the Federal Reserve printing billions of dollars have been injected into the market, even just these past couple of weeks. Is there an end in sight?
Well, I think that's the problem of trying to say the system is unsustainable, but we don't know when, right? So a quick example I often use, communism. It took 6 decades to fall, right? So it was a terrible system. For decades, there were a lot of people who were starving. They needed a black market to survive in that system, but yet it still took a long time for it to fail. And so while I say, yes, the current system is unsustainable, we don't actually know when, because there's just too many variables at play here. Because I think the likely pathway I would suggest is that central banks and governments will continue to try and kind of reflate the bubble, if you will. They'll keep trying to pump it up and keep it going. They're basically just going to keep trying to kick the can down the road because that's more politically amenable for them, because nobody wants it to crash on their own watch. Right. Yeah. And that's why you see Donald Trump now saying, oh, the Federal Reserve needs to lower interest rates. And from his point of view, right, he's like a property guy. And obviously him as a property developer in his career before being the president obviously benefited greatly from having low interest rates. But as Austrians would suggest, the interest rate is itself like a ratio of prices from, based on what we call your time preference. Right. So what we would say is, so time preference here means, think of it this way. If you are high time preference, you are impatient. If you are low time preference, that means you're more patient. So another way to express that is saying, if I said to you, Ben, how about you give me $100 now? How much would I need to give you in a year's time for you to do that? And you might say, oh, okay, Stephan, I would do that for $110, right? So you want a 10% return, right? And so that is an interest rate, and that should serve to help coordinate the structure of production, the capital structure, as we were saying. And so what we're saying is that essentially when the central bank manipulates the money, when the government has legal tender laws and bailouts and so on, the net effect of this is to manipulate and centrally plan the interest rate, when the interest rate should actually be set by individuals, you and me, and that should be based on the so-called the market for loanable funds, right? The market of how much am I willing to give you and give up. If I'm giving you $100 and I'm giving that up for a year, what is the rate you would have to pay me for me to say, yeah, Ben, I'm happy to give you $100, and maybe in a year's time you pay me $110 or $105, whatever that interest rate is, 5%, 10%. And so that interest rate is very crucial. It's very important because it helps coordinate the rest of the production in society. So your listeners who are into more like finance and economics, they would understand this concept of net present value. So that's this idea where you take, let's say in the future, I know I'm going to receive X, Y, and Z payout doing this project. But another factor that's very important is, what is the interest rate in the economy for me to know, am I making profit or not on that? Because if the interest rate is very, very high, then that means the future return that I'm receiving needs to also be very high. Think of it like I'm paying a very high cost to borrow. So my project that I'm going to invest into better also return a lot. And so it sort of helps coordinate the different production in society, and entrepreneurs, they need that, because not every entrepreneur is doing things that pay off today, right? Yeah. So some entrepreneurs, right? And if you're in the forestry industry, or if you're making certain types of alcohol where it's aged whiskey or so on, right? It takes, that production process might be 10, 20, 30 years or more. So they really need the interest rate to help coordinate that over time. And so for them, they need to be able to coordinate their production across that time. And the interest rate needs to be a free market price signal, not a government controlled signal, if you will.
Yeah. It perverts the free market. Now, I guess my question is, so we had at one point a kind of I guess you could say an Austrian system with the gold standard. Would you agree with that?
So there's a few things with that. So I would say, so if your listeners have, or if your audience have listened or read the Bitcoin Standard, there's a section there about the classical gold standard. But then that changed in 1914 with kind of like a government gold standard. So there is a difference. And we would say probably the classical gold standard was a little bit of a better example, because even in the in the government gold standard, it's kind of setting the price of gold. So we would say that system was a little bit better. But yeah, your broad point is that.
So let's go back to the classical gold standard. What did that look like?
So it was a period where we had a lot more growth, and we had a lot more production and a lot more sort of longer term consideration of things. And during that period, we saw better stability in terms of like economic stability as well. Now, that said, there will still be reasons for, sort of little kind of booms and busts, if you will, or we might see, say, a supply shock, maybe a big mine goes offline, or something happens, or there's a famine, like there's a really bad crop one year, or things like that. But fundamentally, it was a much more productive and prosperous time. Now, obviously, the obvious point is, yes, okay, the technology that we have later was better, because but it was part of understanding Austrian economic theory is understanding, did we do well because of something or in spite of something, right? And so, yes, even today, while we have fiat money, yes, okay, obviously we've got this amazing technology, we've got computers, I'm chatting with you, you're on the other side of the world, I'm here in Sydney. So yeah, obviously there's that point that has to be made. But in terms of how would we have grown, or another way to express that might be, if we had lived under a world of sound money for the last 100 years, we might be even further ahead than what we are now. Yeah, right? We would have even better technology than what we have today, because you've got to think of it in a comparative sense and say, okay, what is the alternative world that would have happened? What's the hypothetical, or what's the counterfactual?
Well, and when you look at people's lifestyles, yes, they've got a lot of great things around them. I've got, a great microphone, a nice MacBook sitting here. I've got my iPad beside me. There's all this stuff. But a lot of people have been able to attain that not through their own, basically they're living above their means. They're spending money that is not theirs, because the system that we're living in encourages that expenditure. It encourages that blatant consumerism. And when buying items, people are thinking typically very, very short term. The money almost incentivizes you to spend it before it's worth less. And even though it's not, in Western countries, it's not as discernible, the loss of purchasing power, it does kind of weed itself into the back of your mind. And in order to get the most bang for your buck, you spend it sooner. Naturally, it's just kind of this cultural formation around our economy. Would you echo that?
100%. So that is also a cultural consequence of fiat money. And what that does is it drives this whole behavior of wanting to take on debt because the incentive is that way. So typically what we see is, young professionals, and they come out of university, they typically work for a few years, and then what do? They get a mortgage, because the fiat inflation system is kind of pushing them in that direction, because everybody is trying to chase this capital gain of owning a property, or of, stocks even, and so on. Now, correctly considered, yes, stock market is a good thing that people can invest, they can build their wealth. But the point to be made here is that in this fiat inflationary system, if you take out a big loan on a mortgage, let's say you buy a house for 300,000 or whatever, right? However much the house costs, that over time, or maybe you don't explicitly know, but you understand that over time, that $300,000 that you initially contracted for, that you initially bought the house for, you're paying it back in money that is going down in value over time. Mm-hmm. And so the idea is that over that 25 or 30 years or whatever it is that you're paying the mortgage for the house, at the end of that, you've now got a physical property that you have paid in like a diminishing money for, mm-hmm. because you were, for most people, right, as you earn, your career is rising, you're earning more, that kind of thing, right? But understand that's kind of a difference in the way people act. And I guess maybe that's kind of a way people try to build wealth in today's world. But to your point, absolutely, it drives a lot more short-term consumerism as well. And it drives even the way companies produce products is anchored or kind of targeted for that kind of consumerism. Whereas, potentially we might see, let's say we lived in the opposite sort of world we might see companies make things that were built more to last, and they will be more judicious about their purchases. But we might see people, instead of going into debt to buy things, they would think of it more like, hey, let's save up first and then buy the thing I need, because credit is not so easy to find. Now, that's not necessarily a bad thing. It would be a slight difference in the way society works and is set up.
Yeah, absolutely. Now, so in our current system, in our Keynesian economics world that we currently live in, all of a sudden we've got this juxtaposition where we lost the gold standard because, again, it kind of was easily subverted, I'd say, from a mix of things, but a lot of it, I would say, had to do with people's complacency and allowing government to take control of it and then confiscate and then set the price and lower and then get rid of the peg entirely. So we lost the gold standard, but now we've got something different. We've got Bitcoin, and it's this injection of kind of these Austrian type values juxtaposed against the backdrop of this Keynesian economics world. And so in an instance where we have something like Bitcoin, and it's not easy to stamp out, like you can't just go around the world and easily confiscate it all. You can't just shut it down. You can't just kind of set the peg value and expect the world, especially in today's connected age, to assume that your peg value is the real one. What happens? What's the trajectory here?
Yeah, so I think probably the best way I've heard to express this is as our friend Stephan Livera, the author of the Bitcoin Standard, expresses this. He would say this something like, gold had certain vulnerabilities in terms of how centralized it became. And so therefore it was easier for a government to go and co-opt or control that. Whereas with Bitcoin, because part of the ethos of Bitcoin is that, you hold your own keys and that you are running your own full node, and that these are decentralized and it's easy enough to do that, it just creates a scenario where it's just too difficult for any one government or any one company to try and influence Bitcoin or to confiscate everyone's Bitcoins, because it's think of it like a defensive technology that everyone can just cheaply apply and just use. And it really changes that calculus, if you will. It's like an asymmetric technology, because it's like much cheaper to defend your value against inflation than the government can, than the cost for the government to try and inflate or control or exert power over that. And so I see it like Bitcoin is a parallel financial system that more people we're sort of building this together, that all the Bitcoiners around the world are building their own little parallel financial system that is open, it's permissionless, people can't easily stop it. And because it's built on the hardest, money, and what's a hard money? It's a money that's hard to make, meaning that the incoming supply of that money is very, very low relative to the already existing stock. So there are different ways. Yeah. So there's different ways to express that, right? So stock to flow is one way to express that, or another is just simply having a low inflation rate, right? Just literally just a low inflation rate. That's what it is. And so Bitcoin currently is disinflationary. It's increasing at a very decreasing rate. And obviously, as you know, and as your listeners probably are aware, there will never be more than 21 million Bitcoins. And so that is something that people can focus on, and they can understand, okay, here is the percentage of Bitcoin, however many, let's say you own, half a Bitcoin, that it will stay.
Or 6.15.
Yeah, or 6.15 if you're a fan of American Hodl. But so essentially it will help people be more sure in their property right in some ways. And so in doing so, that allows them to more appropriately and correctly perform economic calculation and understand what costs and the benefits, and understand, am I making a profit overall? And it will be very clear to people, are they making profits in that? Because it's very clear, this is the harder money. And so people would rather store some in that as opposed to leaving too much into the fiat system, because that fiat money is continually just being devalued over time. And over time, people will see the benefit of that. So I think another easy way I can explain this is, if you think about what happens in some of the more basket case countries with inflation, right? So, the Venezuelas, the Zimbabwe's, the Argentinas, the Brazils of the world, and others. Typically what happens in those economies is they do what's called dollarization, meaning they don't want to, it becomes monetary hot potatoes, right? So they start thinking, oh, as soon as I get my pay, let me go and buy stuff with it, or let me try and get USD with it, because that is how I can preserve my value versus my normal government, which is just creating this massively inflationary system. And so the way I like to think of it, and the way I like to explain it, is think of it like the world is Bitcoinizing. So if those more basket case economies are dollarizing, in a similar way, there'll be around the world, people will start Bitcoinizing, because they would rather keep some value in Bitcoin than leave it in their standard fiat money. Yeah. And now that's kind of the process that I see playing out over the next, now this is not, it's not going to happen overnight. This is a process that will happen, we're talking 10, 15, 20 years. Now, depending on who you look at and what sort of model you're looking at, it could be 10, it could be 20, it could be 30 years. We don't really know. Nobody really has a crystal ball on this point. But I think that is the way the tendency is going. And it also helps that Bitcoin is programmable money, and it is not as susceptible to the same level of financial control and surveillance and basically financial control and surveillance that is exerted by governments, and then they deputize banks and other payment processors and other companies, because the government says, hey, if you don't do KYC AML, if you don't do sanctions law compliance, if you don't do FATCA, CRS, you name it, all these different laws, we'll shut you down. We'll take away your license. So every business sort of lives in fear of that. And unfortunately, that's kind of the hard reality. But like I said, in this Bitcoin financial system that we are this parallel system we're building, we're much more free from those requirements. And the difficulty is on the fiat side. It's not on the Bitcoin side.
Yeah. Now, in this instance, we're talking about Bitcoinization versus dollarization. In this gradual flight to a hard money, do you see it being possible that in the very long run, that there still are multiple systems, either through coercion or social engineering or just straight up competition? Or do you see Bitcoin just sucking the air out of the room? What's your feel on it?
So again, I'm perma bullish. I'm always bullish on Bitcoin. I think it will eventually do that. But that said, I think from my point of view, even if I'm wrong about it being like global money, it might still someday serve a role like gold does today, which has sort of 7 or 8 trillion market cap. But I think the way we can think through this is there is still a tendency towards the most saleable and the hardest money. And so my view is eventually we will live in a world with global money, right? Bitcoin will be the global money. It will just be the denomination. Now, not everybody will transact directly on Bitcoin's blockchain, right? We may use other technologies such as the Lightning Network, state chains, and so on. Some of these other technologies that are coming into Bitcoin. But I think we'll essentially, to put it simply, we will be pricing things in Satoshis or sats, right? Things will be denominated in sats. That's my view on this. But again, I could be wrong, right?
Awesome. I love it. I'm perma bullish. I love to hear that. So now I guess we kind of touched on it, but maybe if you just wanted to tap a couple last times on this, but again, we lost the gold standard. It was subverted. Are there a couple of the main, you said that in Safe's book, he touched on a couple of the qualities of Bitcoin that kind of help it not fall to the gold standard's fate. So when looking at gold, how does Bitcoin fix this?
Right. Yeah. So ultimately, we think of it like Bitcoin has been forged in this environment. It's been designed, it's like what's that Batman quote? It's like you came to the darkness, I was born in it, right?
It's
like
born
that.
into it, molded
Yeah.
by it.
Yeah, exactly, right? So it's like this creature that kind of, it's like the Tarzan who grew up in the forest and like is super strong when he comes out into the normal world, because it just has been formed in such a way, it has been developed in such a way that there is no CEO, there is no leader, there's no person to shut down. And it just has these qualities around it that can make Bitcoin more of an actually truly decentralized alternative to central banking. And so that's kind of the way Safety expresses it in his book. And I think most Bitcoiners would agree with that view, in that it is relatively cheap to run a full node, which is a Bitcoin software that you can run on your computer or a laptop, etc. And in doing so, you can be your own bank. And the cost to do so is much cheaper. And so long as we believe enough people are securing Bitcoin, their own Bitcoin, then they can, in some sense, help preserve the decentralization of Bitcoin, which in turn helps build it as this overall system that can't be so easily manipulated by any one government or company. Now, I think it just also is worthwhile pointing out that the setup of Bitcoin is such that individual holders don't want to dilute their own supply. So if somebody were to come out and propose a fork and say, I propose a fork of 25 million Bitcoins instead of 21, would we Bitcoiners move to that fork? Probably not, because who wants to dilute their own supply? So it's sort of like, it's kind of encoded that into the structure. And so now it's 21 million and not no more. Or okay, the technical actual answer is just that it's like a bit less than 21 million or whatever, because of various things, but basically no more than 21. And so it's just unlikely that any holders of Bitcoin would agree to dilute that.
Yeah, absolutely. Now, so I'm conscious of time. I want to keep it down to a last little bit. What I'm going to ask you, just one final question, and again, just whatever comes to the top of your head, just throw it out there, and then I'll maybe get some resources that people can look to afterwards. But I'm just wondering if you have any bits of advice for any newcomers to the space that are curious and starting to dabble as a new Bitcoiner. What were some of the important lessons, or the important lesson that really helped you along the way as you were getting started?
So yeah, great question. There's a lot of learning that you need to do in Bitcoin. I think you sort of have to have at least a basic awareness across different subjects. So you need to understand, obviously, a bit of Austrian economics to understand why Bitcoin and some of those components. You need to understand a little bit around the cryptography, just to understand a little bit about how public key cryptography works and this concept of private key, public key. You need to understand a little bit around open source software and what is open source software, what is the culture of that, how does that help Bitcoin stay decentralized. You have to understand a little bit around the political economics of it. You have to understand some of these little components that, when all put together, help improve your overall understanding of what Bitcoin is and why it's doing what it's doing and how it may continue to remain doing what it's doing. And in doing so, then people can think more clearly about how they would like to buy Bitcoin, how they would like to secure their Bitcoin, how they would like to interact with Bitcoin, and also how they would like to contribute to Bitcoin if they want to. Hodling is great as well. Obviously, no problem with being a hodler, but I think this is a people-led revolution, right? This is there's no one coming to save us. It's basically, it's people who are trying to help educate. And so if after you've taken some time to learn, it's also a good thing to contribute back as well. And there are different ways to do that. That could be by contributing money to development of Bitcoin. That could be by doing development yourself. It could be by testing out software and giving feedback to the developers. It could be by helping write documentation for that software or hardware. And it could be by also just sort of helping advocate or helping explain to people what's coming, because I think there are big changes coming, and a lot of people are going to be caught off guard by that. And so I think Bitcoin needs there's a lot of work to be done, basically. But yeah, so I think high level, I would say, as we always say in Bitcoin, one of the first lessons in Bitcoin is, the first investment you should make is in your education. So you need to do your own learning and try and find some of the high signal resources out there in the space. And hopefully that will sort of put you on the right pathway to holding your own keys and learning to run your own node and so on. And from there, you just go from there.
Take it day by day. Learn, hodl, educate others, and build is what I got from that. That's great. I love it. So Stephan, again, thank you for being on. I'm wondering if you could list a few places where people can find you, or if you have any other resources that you think people should check out, feel free to toss them out there.
Yeah, sure. Probably, look, you can find my podcast by searching Stephan Livera Podcast on any podcast platform, or just go to my website, stephanlivera.com. You can find all the links there, basically. I'm active on Twitter, and I have a YouTube, but yeah, mainly my main thing is the podcast. So check that out. And one other thing, so I do have an Australian Bitcoin education company that's called Ministry of Nodes. So you can find that by searching Ministry of Nodes or ministryofnodes.com. But yeah, that's great. And look, thanks very much for having me on.
Yeah, thank you so much, Stephan. And guys, all those links that we talked about will be down below in the show notes. So Stephan, thank you again. Have a great rest of the day. I hope to see you again soon.
Thank you. See ya.
Thanks. See ya.